And we are in the Market Watch website and we're looking at Nike financials. Looking at the income statement. Just scroll a little bit and you will see here ratios. Go ahead and click that so you can see all the ratios. So there are 4 things I'd like you to quickly look at when you're looking at an income statement. You want to look at, first of all, sales or revenue. And obviously you want the sales or revenue to grow over time. And you can see in the case of Nike, it has been steadily growing and has had a rather major drop in 2020 because of COVID-19 related store closure. So this is acceptable. The second metric I'd like you to look at is Cogs growth. Cogs stands for cost of goods sold. Cost of goods sold is the total direct costs such as direct labor and raw materials needed to manufacture, for example, the Nike shoes. As sales increases, it is natural to expect COGS to increase. However, if Nike is an efficient company, then the rate at which sales increases should be higher than the rate at which COGS increases. Let's see if that's true for Nike. In 2017, sales increased 5.5%, but COGS increased at a higher rate of 7.7%. This means that Nike would have had a lower margin. Let's look at 2019, where sales increased 7.6% nearly, and COGS only increased by 6.61%, and this is good. Let's look at 2020. Sales declined 4.4%, but COGS declined only 2.46%, and this is not very good. This implies that Nike did not sell as many shoes as they originally planned. However, they probably consumed more of the costs because you produce before you can sell, and therefore Nike could not reduce the costs as much as sales decreased by. Here, and we're back in our Market Watch website and we're looking at Nike again, and this time we shall focus on net income. Net income is the final profit of a company, and it is the profit after paying off all expenses, including COGS that we discussed earlier, salaries, utilities, rent, interest payments, taxes, all expenses. After all expenses, what is left behind? The total profit for the company. This is net income. And obviously, we want net income to grow. And so let's see if Nike has been doing a good job. It has had a very good trend, except for 2018, a rather huge dip. Nike's net income dropped by almost 55%. We should see why that was. If you recall, 2018 was a bad year for the US stock market. Still needs little further investigation, I think, because look at this. In 2019, it jumped up over 100%, doubled. Net income doubled in 1 year. And then, of course, 2020, there is a nearly 37% drop because of COVID-19. Let's look at what happened to Nike between 2018 and 2019. If you recall, one of the reasons that income increased could be sales increased. Although sales increased over the last few years, you can see that the increase is only about $2 to $2.5 billion. It cannot justify 100% increase in profit. So something else is impacting profit. And guess what? I found it. I found it right here in income tax. Nike had an unusual tax burden in 2018. It went from 646 million paid in 2017 to a whopping nearly $2.4 billion in 2018, and that definitely impacted Nike's net income. And in 2019, the taxes went back to normal, as it has been paying in the past years in 2016 and 17, and therefore profits are back up. So I think we can discount this one-off drop. I think Nike is growing steadily, except for 2020. So what we have to ask now is, do we believe Nike will recover in the second half of 2020 and as well as the first half of 2021? See, easy peasy. Thank you very much.